It was September 15th, 2008.
The signs were everywhere, but now it's official, we are in a recession.
An American global financial services firm called Lehman Brothers filed for bankruptcy.
I think this is the most significant financial crisis in the post-war period.
It was a different time. Donald Trump was a reality star, Tesla was an unknown startup, and Barack Obama was a first-time presidential candidate. After Lehman Brothers filed for bankruptcy, global markets immediately plummeted.
Down 1.7% here, a loss of 37 points or so. Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4 5%.
But the question now, when will it end?
The Great Recession began well before 2008. The first signs came in 2006 when housing prices began falling. Lehman Brothers was an American global financial services firm founded in 1847. Before filing for bankruptcy in 2008, Lehman was the fourth largest investment bank in the United States of America, behind Goldman Sachs and Morgan Stanley. With about 25,000 employees worldwide, it was doing business in investment banking, equity, fixed income, and derivative sales and trading research. Investment management was also part of the private investment bank. Lehman Brothers was operational for 158 years from its founding in 1850 until 2008. Not only he was the longest serving CEO of the Wall Street, Richard Ford was also considered as one of its toughest. But his business once, worth more than $45 billion, went bust on a September afternoon.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Two-year note yields went from 190 to 166 in the blink of an eye.
The NASDAQ, everything and more has been completely wiped out.
It was the worst day on Wall Street since the crash of 1987.
Ford was the longest tenured CEO on Wall Street at the time of financial crisis of 2007 and 2008. Ford had saved Lehman through the 1997 Asian financial crisis, a period where the firm's share price dropped to $12 in 1998. Lehman had a yearly loss of $102 million in 1993. But after Ford became the CEO of the firm, had 14 straight years of profits, including $4.2 billion in 2007. Although in 2008 it reported of a loss, a Q2 loss of $2.8 billion, and filed for bankruptcy later this year. Now I understand, a great question comes into our mind. Now how did this happen? Lehman Brothers had significant exposure to the subprime mortgage market, which refers to loans given to borrowers with lower creditworthiness. The subprime mortgage crisis unfolded in the United States, with the increasing numbers of borrowers defaulting on their loans. Lehman Brothers suffered substantial losses on its mortgage-related assets. They had a high level of leverage, and meaning that it relied heavily on borrowed funds to finance its investments. This strategy amplified their potential returns during good times, but also exposed them to substantial risks. The firm had a large portfolio of complex and illiquid financial products, including mortgage-backed securities and collateralized debt obligations, which refers as CDOS, which became increasingly difficult to value accurately. Now, the decline in housing market in the United States played a crucial role in Lehman Brothers' downfall. As housing prices plummeted and the numbers of foreclosures rose, the value of Lehman mortgage-related assets declined sharply, leading to interconnected massive write-downs and losses. As Lehman Brothers faced mounting losses and concerns about its financial health, investor confidence in the firm began to erode. The market became skeptical about the accuracy of Lehman's financial statements and its ability to avoid the crisis. The loss of confidence made it challenging for Lehman Brothers to raise additional capital or find a potential buyer to rescue the firm. The bankruptcy of Lehman Brothers sent shockwaves through the global financial markets. Stock markets plummeted, credit markets froze, and there was a widespread loss of confidence in financial institutions. In response to this crisis, governments and central banks around the world took extraordinary measures to stabilize the financial system. They implemented massive bailout programs, injected capital into struggling banks, and provided liquidity support to restore confidence and prevent further failures. The US government initiated the Troubled Asset Relief Program, which is referred to TARP, to provide financial assistance to troubled financial institutions. Lehman Brothers bankruptcy was followed by the failure or near collapse of several other major financial institutions. Some institutions were acquired by stronger entities through forced mergers, leading to a consolidation in financial industry. The financial crisis highlighted the need for regulatory reforms to address the vulnerabilities and the risks in the market. The governments enacted new regulations and strengthened exciting ones to enhance oversight. Dodd-Frank Wall Street and the Consumer Protection Act was passed in the United States, introducing significant regulatory changes. The global financial crisis, of which Lehman Brothers' failure was a pivotal event, triggered a severe economic recession in many countries. The crisis led to a contraction in economic activity, widespread job losses, and a decline in consumer and investor confidence. Government implemented stimulus packages and pursued expansionary monetary policies to revive their economies. Banks and investors became more cautious in their lending practices, risk assessment, and investment decisions. The impact of Lehman Brothers' failure was not limited to the United States. It had global ramifications, affecting financial institutions, economies, and markets worldwide. Many countries experienced banking crises, stock market declines, and recessions, highlighting its interconnectedness of global financial system. The US government implemented fiscal stimulus measures to boost economic activity and create jobs. The American Recovery and Reinvestment Act of 2009, valued at around $800 billion, aimed to stimulate the economic recovery through its infrastructure projects, tax cuts, and increased government spending. It's important to note that the recovery from the 2008 recession was a gradual and uneven across different sectors and regions. The recovery process involved in combination of government policies, monetary measures, and the natural resilience of the economy. So guys, if you like this explanation, please support me by liking and subscribing, and I'll see you in the next one. Have a good one.